Welcome to the yield tree. Just recently, a violent shift occurred in the underlying sectors of the global gold and silver markets. But this tremor made no sound, no headline breaking news, no urgent tweets from Fed officials, not even a single dramatic economic indicator going haywire. This time, the signal came through subtle adjustments in futures positions, abnormal spikes in volatility indices, and the liquidity friction hidden behind the curtain. If you are still waiting for mainstream media to explain why metal prices are fluctuating, then you are not an investor, you are just the exit liquidity of this system. The current truth is that gold is displaying a resilience that defies traditional gravity. It refuses to fall, even when all textbook theories point to it being due for a crash. Silver is like a fully stretched steel wire, undergoing a disturbing, pulse-like snapping. And platinum, the forgotten giant, is beginning to emit heavy-breathing sounds as if awakening from a decade-long slumber. When these three metals simultaneously exhibit such specific yet divergent behaviors, this is no coincidence. This is a structural repricing of the world's most fundamental assets. We are crossing beyond the trading phase, entering a long process of trust reconstruction. The vast majority of people are used to looking for logic in the headlines. They stare at CPI data, stare at dot plots, stare at the political theater in Washington. But long before the market reacts to policy, it has already reacted to a certain tone. In the coded language of macroeconomics, watching the data translates to, "We've lost control of the steering wheel." This feeling of losing control doesn't erupt in an instant. It slowly builds up through countless sleepless nights of liquidity testing. We must realize that we're in the midst of a massive paradigm shift. The starting point of this shift isn't the raising or lowering of interest rates, but the collapse of global credit. The prosperity of the past 40 years was built on an illusory consensus called the dollar standard. And this consensus is now being replaced by an older, more physical logic. Let's first do a deep dive into why this wave of changes hasn't appeared in the news headlines. The narrative logic of traditional media is lagging. They need a definite cause and effect relationship to fill the gaps in time. For example, CPI is high, so gold should fall. Interest rate expectations are high, so silver should be under pressure. But this logic has completely failed in the current macro context because gold is no longer seen as a hedging tool tied to the dollar interest rate differential. It is returning to its most primitive and core identity, the ultimate settlement asset. When this settlement logic starts to dominate the market, all macroeconomic indicators become noise. Look at those treasury auctions. On the surface, they closed, and the government got its money. But look a little deeper. Buyers are becoming increasingly picky, and the auction tails are getting longer. Pricing is under more pressure because the credibility of the debt is no longer enough to support such a massive scale. This isn't a crisis yet, but it is friction. Gold is the most sensitive sensor in this system. It can feel the heat generated by friction before the financial gears start smoking. The current trend feels controlled, cautious, like testing the floor's load-bearing capacity before moving in heavy furniture. Behind this caution hides a deep fear. If the world's largest debt market starts showing cracks, who can be the guarantor of last resort? The answer is obviously not another piece of paper. Let's shift our perspective to the differentiated performance of these three metals. Gold now feels very stable. It behaves like an insurance policy that is being quietly repriced upward. This steadiness doesn't stem from speculators' frenzy, but from the secret allocations by global central banks and ultra-large family offices. They no longer care about next month's non-farm payroll data. What they care about is the sovereign credit default risk over the next decade. Gold's stability is actually a direct reflection of its elevated status on the financial system's balance sheet. It is transitioning from optional allocation to must-hold. Silver is a completely different story. It is caught in an almost frenzied tug of war. On one hand, it is the indispensable lifeblood of modern industry, especially the new energy revolution. On the other hand, it is also gold's shadow. Silver's current volatility is actually the system testing the limits of its supply elasticity. It is like a tightly stretched string. Any tiny position change can trigger disproportionate price swings. This choppy movement is actually telling us that physical market supply has tightened to a critical point. Those institutions accustomed to shorting silver prices in the paper market are facing increasing physical delivery pressure. Every pulse-like rupture in silver is a scream from the shorts as they exit. As for platinum, this variety long forgotten by the market, its awakening carries landmark significance. Platinum's market depth is extremely shallow, meaning it is the most sensitive to liquidity changes. When platinum starts showing unusual buying interest and price recovery, it usually means large funds are searching for any exit to escape inflation and credit collapse. Platinum's liquidity friction is the result of long accumulated structural problems on the supply side. And now the warming demand is breaking this fragile balance. We need to introduce a core quantitative tool, CVO. The volatility index is not a crystal ball. It is a thermometer. Gold CVO is currently at elevated levels, but not chaotic, indicating that uncertainty is being professionally digested by smart money. No one is panicking, but everyone is checking their parachute. Silver's CVO shows extreme instability with massive spikes followed by unnatural compression, perfectly matching the violent price reversals. Platinum's CVO, on the other hand, tends to quietly start rising before price moves. This is what I've been emphasizing when volatility rises while price stays firm. That is pressure. When volatility drops while price remains elevated, that is acceptance. Currently, gold is in the acceptance phase, while silver is still in the negotiation phase. This negotiation is extremely brutal. In the futures trading floor of the Chicago Mercantile Exchange, every change in position represents a bet on the future. We observe that despite margin requirements continuously increasing, despite the massive selling pressure from shorts, the bottoms of gold and silver are being steadily lifted. What does this indicate? It indicates that physical demand is devouring all the paper supply. This is a showdown between real assets and fake certificates. At the yield tree, we don't just stare at screens, we also stare at vaults. A huge crack I am currently observing is the decoupling between paper prices and physical reality. Every day we see large amounts of gold, silver, and platinum flowing out from retail holders. But the logic behind this is thought-provoking. Why are they selling metals to us? Because local coin shops tell them, we're full. Large dealers are starting to refuse to quote for certain products, or only quote for specific varieties with extremely high liquidity. This is the embryonic form of selective liquidity. It is the first stage of system freeze. It is not that there is no market anymore, but the market is turning into an elite club with an extremely high threshold. If you are holding the wrong variety, or you are in the wrong jurisdiction, wealth can suddenly become extremely difficult to liquidate. When a dealer is no longer willing to buy back a certain asset, they're actually expressing doubt about future clearing capability. They worry that these physical assets in their hands might not be able to settle at higher levels in the future. This fear is contagious. It spreads from bottom-tier retail dealers all the way to top-tier commercial banks. This transmission process is very slow and covert, like termites eating away at pillars. By the time you can see the dust falling, the main beam may have already rotted. Meanwhile, what we're seeing is an extremely calm institutional buying. No retail-style frenzy, no fake euphoria, just methodical purchasing focused on settlement. They don't want paper contracts. They want gold bars, serial numbers, absolute reliability of counterparties. This combination of increasing sellers but pickier buyers tells us the market is clearing out weak holders. Risk management tools have been activated. This is no longer a casino. This is a fortress. Institutional investors are building what is called a final defensive position. A position they're not planning to sell in the next 3 years. They're the cornerstone for supporting the entire balance sheet. To navigate the storm ahead, you must ignore all the noise. Focus on these 5 mathematical signals. First is the relationship between real interest rates and nominal interest rates. When the gap between them widens, the opportunity cost of holding gold disappears. Watch the spread, not the Fed's mouth. Real interest rate is the ultimate measure of currency purchasing power erosion. When this number turns negative or stays depressed, gold's rise doesn't need any other reason. Second is the demand quality of treasury auctions. This is an area ignored by most retail investors. If those indirect bidders stop showing up at treasury auctions or their subscription ratios keep declining, then gold will become the only top-tier asset left, because gold is the only collateral that carries zero counterparty risk. In today's increasingly fragmented global clearing system, the premium for this attribute is being rediscovered. The third is CVL divergence. This is a very advanced trading signal. Watch for moments when silver volatility spikes while gold volatility remains flat. That is a precursor to the price-ratio relationship breaking down. Typically, this divergence signals that a massive move is about to begin, because this difference in volatility represents huge disagreements in capital flows within the market. The fourth is exchange margin sensitivity. When exchanges try to cool down the market by raising margins, but prices remain firm or even rise, the shorts have already been handed a death sentence. This shows that the bulls' financial strength has grown powerful enough to ignore the increased leverage costs they're buying. Metals not for leverage speculation, but for physical possession. Finally, there is the physical premium. This is the most intuitive and also the most ruthless signal. When the ratio of paper trading volume to physical delivery exceeds historical norms, force majeure is no longer conspiracy theory, but a mathematical inevitability. We can see that inventory in London and New York is being continuously drained, flowing to regions with more ancient beliefs in gold. When Western paper exchanges don't have enough physical metal to meet deliveries, that day will be the moment of gold's true repricing. We need to understand what we're discussing now isn't a simple investment vehicle. What we're discussing is the underlying logic supporting the entire civilization's financial architecture. Since the collapse of the Bretton Woods system in 1971, humanity has attempted a 50-year-long fiat currency experiment. The core of this experiment is trust in the government's taxation ability, trust in the bank's credit expansion, trust in that unanchored piece of paper. But when debt scales reach 3 times, 4 times, or even more of GDP, the marginal utility of this trust has already diminished to zero. The current repricing is essentially humanity searching for an asset that can prove value without needing permission. Gold doesn't need the Federal Reserve's endorsement. Silver doesn't need Wall Street's audit. They are physical values that objectively exist in the universe. When global geopolitics begins to fall apart, when trade barriers rise again, when financial sanctions become routine, these physical values are the only universal language. This is why gold can still reach all-time highs in the face of ultra-high interest rates. This shows that the old regression models are already obsolete, and a new era has begun. In this new era, liquidity will become extremely expensive and scarce. Those who hold physical metals are actually holding admission tickets to the future world. These admission tickets are not for getting rich, but for ensuring that when the system reboots, you still have chips to participate in the game. We can see that sovereign funds around the world are accelerating decentralization. They're shipping gold stored abroad back to their home vaults, switching foreign exchange reserves from US dollars and treasury bonds to physical resources. This behavior itself is a vote of no confidence in the current monetary system. Silver's role in this process is also undergoing a mutation. As the world transitions to renewable energy, silver's industrial rigid demand no longer has price elasticity. This means that even if the silver price doubles, photovoltaic companies and electronics companies must still buy silver. This rigid demand, combined with silver's monetary attribute as a safe haven asset, is creating the biggest supply-demand trap in history. The current silver price is still in a state of severe suppression, and the source of this suppressive force, paper shorts, is rapidly running out of chips. Platinum is an even smaller and more secretive battlefield, due to its extremely low annual production and concentration in only a few regions. It is highly susceptible to geopolitical events and power shortages. Platinum's abnormal performance often signals a certain anxiety within the physical trading circle. When big buyers start scrambling to buy in such an extremely narrow market like platinum, it indicates that they've already bought up all the gold and silver, or they believe platinum's current valuation has become absurdly extreme. Looking back, all these changes were actually traceable. The key is whether you are willing to step out of the false narrative that has been spoon-fed to you. News headlines only tell you what happened yesterday, while these underlying liquidity frictions tell you what is going to happen tomorrow. The market right now is like a massive cruise ship whose engines have stopped working. Inertia keeping it gliding across the sea, with guests in the cabins still drinking and dancing. But the engineers below deck already know the hull is taking on water and have started looking for lifeboats. This repricing doesn't happen overnight. It is a long, painful process. During this process, many people will get washed out for clinging to old paradigms. They'll keep mocking gold as a useless yellow rock, mocking silver as a speculator's trap. But when the final reckoning comes, when the purchasing power of fiat currency melts like ice under the scorching sun, these useless rocks will become the only anchor that can hold them. We need to think one level deeper. Why is the current repricing uneven? Gold is leading, silver is struggling, platinum is trailing behind. This rhythm is actually pricing different risk tiers. Gold is pricing sovereign risk. Silver is pricing the dislocation between industry and currency. And platinum is pricing the last line of defense for liquidity. This unevenness gives us the best window to observe systemic fragility. We can track the relative strength and weakness of these three assets to gauge how much pressure the financial system is currently under. The truth now is that we're at a point of power transition from pure credit creation back to physical output and resource reserves. Those entities that possess resources, physical assets, and production capacity are reclaiming pricing power from those that only hold debt instruments. Every rally in gold and silver is actually the footsteps of this power transfer. Finally, I want to be clear. This is not a warning about a crash. This is not a pitch for doomsday trading. I am not here selling bunkers or emergency canned food. This is just about the repricing of trust. Over the past few decades, the world trusted paper currency, trusted headlines, trusted those institutional guarantees. But now, that trust is being drained in a planned and uneven manner. It is flowing back to assets that cannot be printed, cannot be observed by committees, and don't need news to prove their value. This repricing process is extremely slow and uneven, filled with deception and misdirection. The mainstream narrative will keep giving you hope, telling you the economy has achieved a soft landing, telling you inflation has disappeared, telling you everything will go back to the way it was. But the underlying mathematical logic doesn't lie. You can control how indices are compiled, you can adjust how data is collected, but you cannot change the compound interest logic of debt. You cannot conjure physical gold and silver out of thin air. If you only watch that 24-hour non-stop rolling news, you can easily miss all of this. But if you observe volatility, observe the friction in liquidity, observe the distribution of positions, that picture will become undeniable. The signal has been given, the math has been done. We are witnessing the end of an old era and the difficult birth of a new settlement system. This system doesn't need your consent, nor does it care about your political leanings. It only follows the most fundamental laws of thermodynamics and economic principles. In this process, the only survival rule is to stay rational. Stay away from leverage and hold as much as possible those real assets that don't depend on others. When you hold physical assets in your hands, you are no longer that number swaying in the wind. You become the observer who can price the current state of affairs. Thanks for watching the yield tree. Here, we cut through the fog to find the real signals. Hopefully, these analyses will help you see the depth that others can't during the next market turbulence. Stay rational, stay hedged. Don't let headlines lead you by the nose. Be the one who can hear the silent pivots in this era. Built on debt and lies. Truth is the most luxurious safe haven asset. Happy stacking.